Well, thank you, Dan, and thank you to tax analysts in NYU for organizing this event. And also, I note we have 3 alumnus of the Joint Committee on Taxation here. It is often maybe an underappreciated part of our tax legislative process. I'd also like to recognize Jim Wetzler, former Deputy Chief of Staff of the Joint Committee.
And our boss.
And our boss, who hired me, actually, in 1982, who played a very important role in creating the very strong organization that it is today. So I'm going to focus on the business side of tax reform, and I really want to talk about 2 things. One is what are the problems in our current tax system that I think there's pretty broad agreement on both sides of the aisle in the business community and academia that really should be fixed, and then talk about what some of the options are to address these issues. I think I'm going to end up where Dan is, which is that the options that actually will do the best job at fixing the problems seem not to be politically feasible, and the options that may be politically feasible probably won't fix a whole lot of the problems. So I'll telegraph where I'm headed with this. So Dan touched on what I would say would be the key issues that there's pretty broad agreement we should address. One is a very out-of-step corporate income tax rate. As you all know, the U.S. corporate income tax rate, when you combine the federal with the average state rate, is over 38%. The average for the other OECD countries is 23.8%. There's more than a 15 percentage point gap. And it's just getting larger. 3 of the other G7 countries have announced further corporate rate reductions. France is going down from 34 to 28 in 2020. If Macron doesn't change the policy, Italy has announced a 2% rate reduction from 25 to 23 next year, and the UK is announced going from 20 to 17 in 2020. So. This is a very strong trend of declining corporate income tax rates around the world. Back when I was on the Joint Committee and we lowered the corporate tax rate to 34, we were about 5 points less than the average for the other OECD countries, and now it's completely flipped, not because we raised our rates so much, we just went from 34 to 35, is that other countries, due to the pressures of tax competition and the mobility of global organizations have found it in their best interest to reduce their corporate rates. The consequence of having such a high corporate rate is that highly mobile business income is not going to be attracted to the U.S. And that is an increasingly serious issue as we see the mobility of income increase just because IP is such an important part of our economy and services. So, we are in a world where you, at your peril, have a high rate that's way higher than the rest of your neighbors. It's also just another consequence of the very, out-of-step corporate rate is that you probably, as a tax advisor, would be shot if you advised a small business to organize in corporate form these days. The combined corporate and top dividend rate plus the net investment income tax gets you up to over 50%. And that is just, at the federal level, forget the state for the moment. And, the highest pass-through rate is 39.6. So we're seeing, a big difference. You need to access public capital markets. You have to be a corporation pretty much, and you're in a very different and higher tax position than the rest of the economy. Another just a basic point is that it's commonly thought that the high corporate rate doesn't really matter because, after all, there are so many loopholes in our tax system. Our effective tax rate is really low. There is not a whole lot of support for that position. I'll just mention a few studies that look at what's called marginal effective tax rate. This is the taxes that would be borne on an investment that just earns the normal rate of return. The European Commission did a study where the U.S. came out third highest out of the 35 countries they looked at, 18 percentage points higher than the average for the others. Jack Minst at the University of Calgary found the U.S. number 5 highest out of 45 and 15 percentage points over the average. Congressional Budget Office just came out with a study on the G20. The U.S. came out number 4 highest of the G20. So, you know, it's not the issue that we have this very narrow base, so we could lower the rate and broaden the base in a way that would allow, on a revenue neutral basis, a deep reduction in our corporate rate that would put us in parity with the rest of the world. The other important issue is the U.S. is one of a small number of countries now. If you look at the OECD, 28 of the 35 OECD countries have some form of dividend exemption system, also called territorial, which means that multinationals headquartered in those countries can bring back their foreign earnings, typically with 95% or 100% exemption. Obviously, that's not the case in the United States, and the combination of taxing the dividends when they're brought back at the highest corporate rate in the world means that obviously you do not want to bring back your foreign earnings. So we have a lot of trapped foreign earnings. The numbers are something on the order of 2.6 trillion of accumulated foreign earnings. Maybe half of that is in cash, not in bricks and mortar. That is not going to come home because of the very high repatriation tax. That certainly has a lot of consequences. It makes it much more attractive to buy a foreign company, for example, than to invest in the United States. If you buy foreign company, you don't have the repatriation tax. If you bring back the money to invest in the U.S., you have it. Some have called that a 35% investment tax credit for investing outside the U.S. You also have a big incentive to move your headquarters. So we see a lot of cross-border mergers these days where the choice is made for the merged entity to be headquartered outside the U.S. because if they're foreign headquartered in a territorial jurisdiction, they can get cash that's earned abroad to U.S. shareholders without running it through the U.S. corporate tax system. So that is another very significant drawback. And we also have a tax structure that Dan mentioned is very different than the rest of the world. You know, Johnny is marching out of step, and you know, if you look at the other OECD countries, they get about an equal amount of their revenues from profits and income taxes, about a third profits and income, and about a third on the consumption side, so about equal amounts. The U.S. is very different. We get almost, we rely almost 3 times more heavily on profits and income taxes than we do on consumption taxes. It's 48% reliance on profits and income taxes and 17% on consumption. And why that matters is that you know, the OECD has attempted, it's very hard to do, but to try to analyze how tax structures affect economic growth. And the results of their work with OECD data suggest that countries that rely more heavily on profits and income taxes have slower growth than countries that rely on consumption taxes. It's thought to be one of the least growth-friendly taxes that there is. So it's basically a handicap for U.S. economic performance. And then, you know, you can't talk about tax reform without, I think, also noting the long-term fiscal environment that we operate in, which is one of deficits that are projected to grow very significantly due to the aging of the population. So losing revenue in tax reform is not a good thing. So I would characterize those as the issues, and the solutions. There are sort of 3 broad directions we could go, and one would be the rate-reducing, base-broadening type of tax reform that we think of when we think of the 1986 Tax Reform Act. That's the model that Chairman Camp used, the proposal that Ray worked on. And the second approach would be find a new revenue source. and use that to pay for reduction in reliance on the corporate tax. And that is what Dan talked about with, VAT or destination-based cash flow tax. The third would be corporate integration, and that is the approach that Chairman Hatch is looking at. So just a few comments on that, and I'll turn it over to Ray. So, H.R. 1, it is, a very well thought out, fully drafted proposal, ready to go. But, it, like the 86 Act, is not revenue neutral in the out years. In the 86 Act, we had a 5-year budget window, and we were revenue neutral in the 5 years, but on the business side, we were not revenue neutral beyond the 5-year window. We relied very heavily on timing items to address that. We're also fortunate to, have a way to pay for corporate rate reduction, which was the investment tax credit. We don't have any pot of gold like that here for H.R. 1. So H.R. 1 was not designed for reconciliation. As you know, in reconciliation, where you can pass things in the Senate with a simple majority, you cannot lose revenue beyond the 10-year budget window. They actually look out for the next 3 10-year periods to make that determination. And so that's a really big challenge. And, that means that it would, given our current political configuration, it would have to be temporary, would have to expire. If it's temporary, that really harms your economic growth. It also limits the amount of dynamic revenue that can be used to pay for it. So the challenge is if you adopt a tax system like the rest of the world, unfortunately, at least on the business side, that's going to be something that loses revenue in the long term. We don't have enough base broadeners really to pay for it. The second option is to use a new revenue source. And so Dan has talked about VAT, the destination-based cash flow. We won't go into that in any detail. I will mention that Senator Cardin, my senator, has a proposal, a discussion draft, to adopt a 10% VAT and use that money to lower the corporate rate to 17%. He would also lower the top individual rate to 28%, have a family allowance of $100,000, which would take a lot of folks off of the tax rolls, and enhances child credits and earned income credits to deal with regressivity. This is also referred to as the Michael Gratz plan. So that's a plan that actually addresses most of the problems we've been talking about. And the Cardin plan isn't quite revenue neutral. His rate probably need to go up maybe to 13%. But it certainly could address a lot of the issues that we've been talking about in terms of the problems with the high corporate rate, base erosion, and so forth. So it also has a significant disadvantage, which is, as Dan mentioned, it seems to be completely outside the realm of political feasibility. The destination-based cash flow tax is sort of a version of this. As Dan said, it's repealing the origin-based income tax system, replacing it with a 20% subtraction method of that with a 20% wage credit. That's basically what it is, with a few bells and whistles. And one might have thought that this was more politically feasible because it wasn't a dirty 3-letter word, VAT. It was camouflaged, as Dan said, but what we've found out, at least this is my read, that doesn't work. So the retailers and importers and some on the conservative side of the Republican Party are very unhappy with that approach. So, there are other consumption taxes. Carbon tax, for example, could be used, but I don't think that helps us with political feasibility in our current environment. So the last approach I just wanted to mention is Chairman Hatch's corporate integration proposal. The idea here is to move the burden of the corporate tax from the corporation to the shareholder. And the reason for doing that is shareholders are not that movable. Corporations are. And so The Hatch idea would allow a deduction for dividends paid. He would impose a withholding tax at the corporate rate, and that withholding tax would be creditable but not refundable against the shareholder level tax. To make that revenue neutral, he would need to impose withholding or an interest or denial deduction on interest to make the numbers work. This is actually a very interesting proposal. It can be done if you limit or you put withholding on interest on a revenue neutral basis. It solves to a large extent the corporate inversion issue, because foreign corporations would not get the dividend deduction. It to a large extent solves the trapped foreign cash issue, because if you bring back the foreign cash and distribute it to your shareholders, you get a deduction for it, so there is no repatriation tax at the corporate level. It actually helps with the base erosion issue. The countries with imputation credit systems, another form of corporate integration, find that there's less incentive for their companies to shift their income abroad because it reduces the benefits to the shareholders of imputation credits. The dividend paid deduction would have a similar benefit. It narrows the differences between debt and equity and between corporate and non-corporate. So, it has a lot of desirable properties, but again, politically, it seems like it has zero traction. I don't think Chairman Hatch has found any co-sponsors on either side of the aisle. So that's the gloomy outlook that I have. Feasible reform probably won't solve the problems that both sides of the aisle think are very serious.